America in the 1980s. On the one hand, the end of the Cold War, an America shaped by the winds of Reaganomics and the acceleration of financial liberalization. The glass towers of Wall Street heralded the dawn of a new era, but also signaled a period of heightened risk. Wall Street was turbulent, investors were chasing the markets with a voracious appetite, the state was shrinking, and the power of the markets was growing. And in this turbulent environment, a young financier who had suffered a great loss decided to redesign the financial world. How did BlackRock, which today has become the invisible hand of the global economy, with assets worth more than $10 trillion, rise to the top in such a short time? The story begins in 1986, when Larry Fink, the young manager of the then investment giant First Boston, faced a shocking loss of $100 million in his bond portfolios. It was not only a financial loss, but also a moment of awakening for Fink. Fink learned a life-changing lesson from this painful experience. He lost because he didn't fully understand risk. That's when he decided to understand risk from every angle. The late 1980s was truly a turning point for U.S. financial markets. Technology, globalization, and the complexity of financial products were growing rapidly. But with this growth came new and greater risks. The proliferation of complex derivatives, particularly in fixed income markets, was causing banks and investors to face serious challenges in managing risk. BlackRock was born to fill this gap. BlackRock was founded in 1988 by 8 co-founders: Larry Fink, Robert S. Capito, Susan Wagner, Barbara Novick, Ben Golub, Hugh Frater, Ralph Schlosstein, and Keith Anderson, as a risk management and fixed income institutional asset manager. Initially operating as a small department within the Blackstone Group, the firm quickly demonstrated its potential to stand on its own 2 feet and became independent in 1994. BlackRock's founders read the dynamics of this period very well. The shock of 1987 Black Monday was still fresh, and financial institutions were desperate to better understand and manage the risks in their portfolios. By focusing on this urgent need, BlackRock aimed to go beyond traditional banking and investing. The company committed not only to managing assets, but also to analyzing their risks in a scientific and systematic way. What was the difference? Unlike traditional financiers, they used data to predict risk, not just to understand price movements. They were the ones who found order in the midst of market chaos. While the Reagan administration's small government, big market policy liberalized financial markets, the Fed's interest rate policies caused market volatility. In particular, the explosion of the derivatives market created both new investment opportunities and unforeseen risks. Markets were risky, but they also offered unlimited opportunities. Whoever could best understand and manage these risks would be the winner. This is where BlackRock came in. For them, it wasn't just about avoiding risk, it was about turning risk into a business model. BlackRock saw a unique opportunity here. It was possible to make enormous sums of money even without direct investment. If you could manage billions of dollars of other people's risk with your own revolutionary system. BlackRock's greatest gift to the financial world and the backbone of its company was a software system, ALADDIN, the Asset, Liability, Debt, and Derivative Investment Network. This system was woven into the DNA of the company. This revolutionary system was able to analyze in real time not only BlackRock's own multi-billion-dollar investment decisions, but also the risks in its clients' massive portfolios, optimizing the portfolio and calculating potential risks in advance. This was an unprecedented revolution in financial decision-making. And most importantly, ALADDIN started to improve its own system with client data day by day. So, as BlackRock's assets under management grew, ALADDIN collected more data, analyzed it better. The better it analyzed it, the more clients it attracted, and the bigger it got. ALADDIN was an ecosystem, not just software. Covering all asset classes in financial markets, instantly calculating risk and analyzing scenarios, this platform gave BlackRock a unique competitive advantage. Today, many banks, insurance companies, and pension funds use ALADDIN for their risk management. This exponentially increases BlackRock's influence on the financial system, turning it into the brains of the financial world. In the early 2000s, BlackRock went from being just a risk advisor. It became an indispensable player at the heart of the U.S. financial system. The giant pension funds that manage the retirement savings of millions of Americans, the municipal bonds that finance cities' infrastructure projects, the mortgage-backed securities that are the backbone of the housing market, government bonds, and the country's largest institutional investors, all under BlackRock's management. The first critical step in BlackRock's growth was its acquisition by PNC Financial Services in 1995 for approximately $240 million. This partnership not only provided BlackRock with a significant injection of capital, but also allowed it to leverage the strong infrastructure and client network of an institutional bank. This accelerated BlackRock's access to institutional investors and enhanced its credibility. But it was the merger with Merrill Lynch Investment Managers in 2006 that transformed BlackRock into a true asset management giant. This merger increased BlackRock's assets under management to $1,357 billion, making it one of the largest asset managers in the world. The merger gave BlackRock not only a huge asset base, but also a global distribution network and a diverse range of investment products. In 2009, he bought Barclays Global Investors, and thus became the owner of iShares ETFs. By now, BlackRock was in the pocket of almost every individual investor in the US, even if they often didn't realize it. A retirement account at a bank, an insurance policy, or a mutual fund. Behind most of them was a BlackRock-managed fund, a stock, or a bond. By 2023, BlackRock has become the world's largest asset manager, with more than $10 trillion in assets under management. This incredible figure is equivalent to nearly 40% of the nominal GDP of the United States in 2022. BlackRock's massive asset base has transformed it from a mere investment firm into a central player in the global financial system. The company operates globally, with more than 70 offices in 30 countries and clients in more than 100 countries. BlackRock's power in the U.S. economy is not limited to the size of the assets it manages. The company is one of the largest shareholders in many major American companies. For example, BlackRock is a major shareholder in giants such as Apple, Microsoft, Amazon, Google, and ExxonMobil. These shareholdings usually range from 5% to 10%, but can be higher in some cases. This gives BlackRock significant say and voting power in corporate boards, strategic decisions, and even CEO appointments. For this reason, BlackRock is often referred to as the world's largest shadow bank and is characterized as the invisible boss of the financial system. And that means this: BlackRock can influence who sits on Apple's board, Chevron's climate policies, Amazon's wage policy, and many other critical decisions. And these decisions are often made without the knowledge or direct involvement of the millions of individual investors who invest in their funds. Critics summarize it this way: the game is passive, but the power is active. BlackRock's relationship with the U.S. government is also noteworthy. Especially during the financial crisis, the company became one of the government's key advisors. In the 2008 global financial crisis, while many banks were on the brink of collapse, BlackRock paradoxically grew even bigger. How? Because the U.S. Federal Reserve and the Treasury Department relied on BlackRock to manage assets such as failed mortgage-backed securities. This once again demonstrated the company's market knowledge and the power of the ALADDIN system. The Fed and the Treasury Department have engaged BlackRock as a key advisor to manage the crisis and clean up the bad assets. According to critics, this was a clear conflict of interest. At the same time as BlackRock was advising on bailout operations, it was also able to buy assets in the crisis through ETFs and funds it managed. This led to serious allegations that shook the confidence of both the government and the markets. A similar scenario played out during the COVID-19 pandemic. In order to ensure economic stability, the Federal Reserve commissioned BlackRock to manage corporate bond purchase programs. This role reinforced BlackRock's unique position in the financial markets and increased its influence in the public sphere. When the Federal Reserve launched a massive corporate bond buying program to ensure economic stability, it again entrusted BlackRock to manage it. And BlackRock's own iShares ETFs were at the top of the list. Congress questioned the transparency of this relationship and the potential for conflicts of interest. However, due to the confidence in BlackRock's expertise in crisis management and the unique capabilities of the ALADDIN system, no formal sanctions were imposed. This highlighted BlackRock's unique, some would say too close, relationship with the U.S. government. However, this close relationship has led to allegations of conflict of interest and criticism of being too big. BlackRock's influence is not limited to times of crisis. The company's top executives have direct, close relationships with the Treasury Department, the SEC, and the White House. Even more strikingly, former BlackRock executives were appointed to important positions in the Biden cabinet. For example, Brian Dees served as director of the National Economic Council in the Biden administration, while Adewale Adeyemo became deputy secretary of the Treasury. Both had previously held senior positions at BlackRock. This has been characterized by critics as a company in bed with the state and revolving door syndrome. BlackRock's influence is being questioned not only in Washington, but also in the states, and even faces concrete sanctions. Starting in 2022, the states of Texas and Florida launched an open war against BlackRock. This war was based on the company's environmental, social, and governance-focused investment policies and its tendency to withdraw from the fossil fuel sector. The Texas Department of Finance argued that BlackRock's exclusionary policies toward oil and gas companies hurt the state's energy independence and workforce, which are vital to the state's economy. Texas Governor Greg Abbott targeted BlackRock in a scathing statement. BlackRock is an enemy of Texas energy interests. The state of Florida announced its decision to withdraw its $2 billion investment from BlackRock. Using our money to fund BlackRock's social engineering project is something Florida has never approved of. Florida's chief financial officer Jimmy Patronis said in a statement, "This is not about maximizing returns. It's the opposite of what an asset manager is supposed to do." Florida Governor Ron DeSantis went one step further. He announced the withdrawal of $2 billion of BlackRock investments managed from state pension funds. The reason given was BlackRock's ideological investment agenda and imposition of woke ideology. Florida officials argued that investment decisions should be based solely on financial return and that factors such as ESG are political agendas. Sustainable investing has become increasingly prominent over the past decade, with hundreds of mutual funds focusing on firms committed to ESG principles. However, this approach has faced increasing scrutiny from institutional investors, such as pension funds, who are concerned that they may not be able to meet their fiduciary responsibilities by sacrificing potential investment returns in favor of ESG standards. On the other hand, ESG strategies have faced increasing criticism of greenwashing. Many investors are concerned that ESG-focused investing either leads funds and companies to make baseless claims that exaggerate the positive effects of their policies or downplay the impacts of their environmentally or socially harmful activities, or a combination of both. As an early ESG investment advocate, BlackRock has been targeted by ESG critics across the ideological and political spectrum. Some Republicans see the company as a climate activist, overly focused on the fight against global warming, and as having strayed from its original purpose. On the other hand, some Democrats consider BlackRock's ESG support hypocritical because it continues to invest in companies that they see as anti-ESG, such as fossil fuel producers. These two major states' opposition to BlackRock has highlighted the deep political and cultural polarization around ESG policy in the U.S., and it put BlackRock at the center of the debate. Large-scale direct sanctions against BlackRock are rare given the size of the assets it manages and its critical role in the global financial system. However, the company continually develops strategies to defend itself against criticism and investigations. BlackRock generally emphasizes its mission of transparency, adherence to the principles of corporate governance, and protecting the long-term interests of its clients. BlackRock responds to tensions with state governments and the shareholding voting rights debate with the following arguments. We represent the rights of ETF investors. The shares in our funds are held on behalf of millions of pension funds, individual investors, and institutions. Our voting power is to protect their interests. Our goal is only financial return. We have no political agenda or aim to impose woke ideology. ESG is an assessment of long-term financial risks, not politics. The state's sanctions against us are purely political theatrics. These decisions will impose costs on the respective states' pension funds and taxpayers. BlackRock CEO Larry Fink has emphasized that the broader interests of society are more important than profits and transcend politics. In his annual letter to corporate leaders in January, he said, "Stakeholder capitalism is not about politics. It is not a social or ideological agenda. It is not woke," he said. In response to the investigations into investments in China, BlackRock says that as a global asset manager, it must meet the diverse investment objectives of its clients and cannot ignore China's importance in the global economy. The company says it closely monitors the activities and human rights records of the companies in which it invests and encourages them to act in accordance with international standards. However, these explanations are not convincing, especially in states such as Texas and Florida. BlackRock's ESG policies are perceived by these states as hidden ideological manipulation and corporate activism, and they claim that the company deviates from its core profit-oriented mission. Imagine an investment company. It receives harsh criticism from both the left and the right. It works in close relations with the government, but it can also influence government policies. And in all these contradictions, it still continues to grow and shape the global economy. Today, BlackRock is in the U.S. Market control mechanism, government financial partner, and unknowing partner to millions of individuals. This complex and multifaceted identity makes the company's power and influence unique. And all these roles have one consequence. The impact of big capital and economic power on modern democracies is becoming more controversial than ever. This was only the first chapter of BlackRock's rise within the American dream. In the next episode, we will focus on BlackRock's journey across continents, its rise in Europe, the political crises it faced, and its enormous impact on the European financial system. Don't forget to subscribe, comment, and turn on notifications to be notified of new episodes.